What's up, you guys? Steven Vanderhook back again. Today we are diving into the exciting topic of insurance. Alright, snoozers, boring, next video, let's go. Now, we're going to jump into this and make it a little more exciting. We're going to talk a little bit about insurance, but mostly we're going to talk about what insurance to totally avoid and not get sucked into so we don't lose money in the long run. Usually when people bring up insurance, what comes to mind? You think of auto insurance, health insurance, maybe life insurance, the boring stuff. We're not going to talk so much about that today. That stuff's kind of obvious. Yeah, you pretty much need insurance on all big life items. Obviously, if anything's legally required, you got to grab that, right? If you want to drive, you got to have auto insurance. Different types of insurance, but you got to have it. Health insurance, you got to have it. Life insurance, really good idea if you can have it. It's especially if you're a single dude, whatever. But once you start having a family or you get married, you got to start thinking about that type of stuff and having that life insurance. But we're not going to talk about any of that stuff today. We're going to talk about the type of insurance that you randomly get sold on random purchases that you may not even think of when you think of insurance. So that's kind of the rule of thumb for today. If I say insurance and you think of the big, boring topics, yeah, just get that. But when surprising things come to mind, like phones, refrigerators, TVs, whatever, that's the type of stuff we want to dive into and say, is it really worth it? First of all, when we talk about insurance, you got to remember the basic concepts, right? Real quick, what insurance is you pay a company a little bit of money each month. It's called a premium, but you pay them a little bit of money each month just in case something goes wrong with whatever you're insuring, right? So if you're insuring a car, you're paying every single month some money. So in case you get in a wreck, your insurance company will then step in and say, hey, we insured your driving, we insured your car, we will pay for you to replace your car, right? That's the basic concept of insurance, is that you're paying someone a little bit of money each month in hopes that just in case one day, if you ever need them, they'll be there for you to pay out in case something goes wrong. Now, that is a losing bet, right? The house always wins. If this is a casino, the insurance company is the casino. They always win, and we go in and we make little bit of bets every single month. I say, hey, I'm going to bet you $100, and in case I, win the bet or lose in life and I get in a car wreck, you're willing to then step in and pay money. On average, right, if 10 of us are doing that, most of us will not get in a crash, and so they're going to take the money each month, those premium payments every single month, from 9 of us. And that's going to more than cover their costs of the one person who does get in a wreck, right? So if we're all paying $100 a month for a year and only one person, so what is that? $1,200 a month, so $12,000 in a year, and one person gets in a wreck and they had an $8,000 car, well, the insurance company still has another $4,000, right? And they can obviously, they have other costs they got to cover, but that's the basic concept of insurance. And so when you're insuring a big ticket item like a car or your life or your health, those can be really big setbacks if you need to replace those suddenly. All right, let's say you own your own car, good for you. You don't really want to have to fork out 20 grand out of nowhere out of your own pocket to replace the car, or 40 grand to replace your own car and the car of the person that you wrecked into. So when you think of insurance can be really beneficial in that way. That's why we do it. And yeah, it's legally required, but that's why we opt into a lot of insurance, is because in the case of the event, you really don't want to have to pay all that at once, right? But statistically speaking, right, that's the whole world of actuaries. Statistically speaking, they study this and they know what do we need to charge each individual person every single month so that we come out on top. And the casino always wins. The house always wins with insurance. And that's okay. It's not a scam, right? We know that. But you don't need to insure everything in life. Probably the most commonly insured item that really does not need to be insured is your smartphone. If you can't afford a new phone, you just need a cheaper phone, right? Like if your phone breaks, I'm not saying you want to break it every month and you need to allot whatever, $1,000, $800 into your budget every month, or even every year to replace your phone. But if you can't just replace your phone, you should have a cheaper phone, right? You shouldn't be carrying things that you can't afford to have break once in a while. And that's kind of a rule of thumb, is that if you can't afford to replace it, and it's something simple like a phone, a TV, whatever, a simple consumer item, you're in over your head. You bought too much of that item if you can't replace it yourself. With phones specifically, all the time you go and sign up and you don't really even know what you're signing up for. It's all complicated. You're all excited for your new phone and you got a new plan, and they talk about the upgrades and they talk about everything, and they throw in insurance and they say, hey, when's the last time you had a phone break? And the salesman will tell you a story. Yeah, I fell over and I slipped on some ice or whatever I did, or I bumped into a car and I smashed my phone, and luckily I had it insured, so it was great. All I had to do was pay a little deductible and they replaced my phone. And it sounds all great, and they get you all emotional and you get fearful and you're like, oh man, I don't want to break this brand new phone. What if it breaks tomorrow? I really want to be sure it's insured, so you pay for the insurance. They usually sell on emotions in that regard and get you all scared that something's going to go wrong. But for the most part, how often do phones break? Right? Not very often. And if you happen to be a person who your phone is breaking every 6 months and you're insuring it and you're getting it replaced every 6 months, okay, well, maybe you should walk more carefully or whatever your issue is. But for most people, you probably aren't replacing these items very often. But you're still paying those monthly premiums every single month. You're paying whatever, 10, 20, 15, we'll break it in the middle. We'll say $15 each month that you're paying as your premium. For what? For maybe some peace of mind? And insurance is, a lot of people don't really understand it. They don't understand that they still have to pay the deductible. And so then when they want to cash in their insurance, like, I still have to pay $250 out of my pocket to, I've been paying you $15 every month for 2 years, whatever, let's say a year and a half. So $270, and now I have to pay another $250 as a deductible. What's a deductible? And in order to file a claim, and a lot of people don't understand all this, and so it just goes over their head, and it ends up not being worth it for them. And you realize, well, if I had to pay you $250 anyway, why'd I pay you $15 every month? I should have just bought a new phone. And that's exactly my point. You don't need insurance. You can just buy a new phone, right? If a phone breaks, just trade it in for whatever value you can get, right? Sell a broken phone to someone and get $50 or whatever you can get for it, and just buy a new one. It's not that big of a deal. If it is a big deal, get yourself a cheaper phone, right? But if it's not, it shouldn't be that big of a deal. Same thing with TVs, refrigerators, all that stuff. Like, you don't need to insure all that stuff. Not to mention, by the way, if you make your purchase on most credit cards, now I'm not going to dive into credit cards today and whether or not you should or should not use them, but if you're using it on a credit card, a lot of them, by the way, usually have extended warranty options on electronic purchases and other big ticket items. There'll be specifics on that, specific to your state, specific to the types of purchases that qualify, but there's a good chance that you actually have extended warranty anyway, and your credit card company will be willing to replace that purchase for you. So that's something to consider as well. And the reason we do this, the reason we're willing to replace these phones ourselves, is because in the long run, this saves us money, right? In the short term, when you have to fork out that money, you think, oh man, I had to pay out $800 to get a new phone, or $500, whatever you're spending on your phones. It kind of feels bad. But if you know that that's a potential option and you don't like that feel bad feeling, just insure it yourself. Take that $15 a month and stuff it under your mattress every single month, right? And then when it comes time for a new phone, you have your phone cash already set apart, so it doesn't feel bad. You don't feel like you're losing out on your budget that month for whatever reason. You already had that money. But in case your phone doesn't break, well, then at the end of 2 years, you have all that money under your mattress still, right? And you still have a phone that works. You didn't have to fork it over. You didn't have to make the deductible payment and file the claim and wait and for it all to process. It's just easier to insure it yourself and just make those insurance payments to yourself if you really don't like the feeling of forking out a few $100 at a time for a new replacement item. I'm a big fan of self-insuring, right? Where we just say, hey, I'm not going to pay a foreign company, a third party, to replace my item potentially. I'm just going to be willing to replace it myself. I'm going to use a bit of an analogy here. So oftentimes people will self-insure big things. So let's say you're a big real estate company and you have properties all around the world, right? And you have thousands of properties. You're this huge company. You're worth billions of dollars. If you have that much money, you of course can afford, if you have billions of dollars, you can replace a $2 million building. It's not a big deal, right? It burns to the ground, you can replace it. You fork out $2-3 million bucks and you just build a new one. Now, because it's the reason you can do that is because it's such a small percentage of your net worth as an organization and of how much money you bring in for your real estate company, whatever. Now, I'm not talking about liability insurance or whatever. I'm just talking about like the actual property itself, right? The building itself. Not if someone slips on your property and breaks their ankle, you're going to have your liability or whatever you want to do for that. Just insuring the actual physical property, you can just do it yourself, because essentially you're saying, rather than making 1,000 tiny bets every single month and insuring 1,000 properties all around the world, what's the likelihood that all 1,000 of your properties are going to go under at once, right? If you have an earthquake, it might affect 1 or 2 of your buildings, right? Or a tsunami or wildfire or whatever. it's not going to affect your entire portfolio. And so you lose one building and that's okay. You can just pay for it yourself. That's cheaper than paying an insurance company on all 1,000 of your buildings, right? Does that make sense? So the idea is that through diversification, you can do that. And sometimes you'll see people do the same thing with like collectibles, because you can insure anything, right? You can insure personal property, right? If you have an apartment, you're in a rent, you have renter's insurance, where you say, hey, I want all my stuff insured in case something goes bad, and I want all my stuff replaced. If people have in the world of collectibles, they might have $100,000 worth of whatever it is, comic books, and the way they diversify their insurance is placing things rather than pay insurance for a $100,000 policy. They instead just store them in different places, right? They might have some safe deposit boxes at some banks. They might have a different storefront where they store some stuff. They might have a lock or a safe in their house. And so by diversifying and separating, you're covering yourself and you're making yourself more safe to risk. That's the whole idea of self-insurance. So applying this to your own self, if you think about it, instead of you don't have 1,000 buildings and you're not worth billions of dollars, but you have the money you make every year and you have a ton of different stuff. So rather than insuring, your phone and your tablet and your computer and your TV and whatever else, you have 10 different items you're insuring and you're paying $100 a month to insure all these items. How many of those items are going to break in a year? Maybe one at the most, and then you'll have a good year where none break, and maybe 2 years. So over the course of 4 years, you have 2 items that break. Well, rather than paying that'd be $4,800, right? $100 times 4 years. Rather than paying $4,800 towards insurance claims, and you have 2 items break, you just buy a new $1,000 TV and a new, $800 phone, and that's $1,800 that you had to fork out of your pocket. But you saved $3,000 by not making those insurance claims, right? Those insurance premiums. So that's the idea behind self-insurance, and that you really can just insure everything yourself, quote unquote insure, just by not overextending your means, not overextending yourself, and having cash set aside to just replace items when they go bad. In the long run, insurance companies always win. The house always wins. It's not a scam, it's not a bad thing. I'm not against insurance companies, but I am against insuring small ticket items that you should just be willing to replace yourself. Hope this video was applicable to you and that you learned something new. Like and subscribe, share this video. We'll see you next time. Thanks.